Today's edition of Business Africa is about the opportunities and hope that enterprise and business have for the African continent. Welcome, I'm your host, Afolake Oyiloye. The top stories this week. Sub Saharan Africa is witnessing the rapid development of digital currencies. Do they hold the key to financial transformation and economic recovery for the continent? Let's find out. The Food and Agriculture Organization estimates that $48 billion is lost in post-harvest and retail stages of food. Find out how banana farmers in Congo are solving this problem. And as Europe scrambles to minimize energy dependence on Russia, could the recently discovered natural gas fields in Senegal and Mauritania provide a solution? We'll find out shortly. Now, the future of money is undoubtedly digital, according to the IMF. The question is, what will it look like? As digital currency development is accelerating quickly in Sub-Saharan Africa, policymakers are concerned that digital currencies could be used to transfer funds out of the region illegally and undermine financial and macroeconomic stability, especially in the absence of strong regulatory frameworks. Here is more.
Sub-Saharan Africa is witnessing rapid development of digital currencies. A new IMF report discussed three instruments: mobile money, central bank digital currencies, CBDCs, and cryptocurrency. Crypto transactions in the region peaked at $20 billion per month in mid-2021, but the trend might have reversed after the recent crypto bust. On a scale of 100, Kenya and Nigeria are among the top 20 adopters of cryptocurrency. Private issued mobile money, on the other hand, has been at the forefront of reshaping the region's access to finance, allowing digital payments and transfers at low cost. The report says transacting without any bank account or internet access makes mobile money particularly useful for local income households. In 2021, there were 606 million registered mobile money accounts in Sub-Saharan Africa. $698 billion worth of transactions were executed. Like existing hard currencies, retail CBDCs are issued and fully backed up by central banks and could be used for everyday transactions. In addition to the e-Naira in Nigeria, 11 national central banks in the region are either piloting or researching CBDCs. Policymakers are concerned that digital currencies could be used to transfer funds out of the region illegally and to undermine financial and macroeconomic stability, particularly in the absence of robust regulatory frameworks.
We now talk to Mr. Bebe Selassie, who is the director of IMF's African Department, to shed more light on that report. Welcome to the show. Now, despite the obvious potential the digital currency have in transforming Africa's digital inclusion, why are many African governments still wary of them?
I think it's important to be clear what we're talking about. I think, what matters really for inclusion is the ability to have access to, services like fintech. It's not necessarily having central bank digital currencies. So I think that's a very important distinction to make. Why am I saying this? I'm saying this because, we have countries like Kenya, Rwanda, Uganda, many more in the region, where financial inclusion has, the progress on financial inclusion has been really astounding, and are leaders in terms of having giving people access to financial services using telecom platforms, and have done so, for a decade or more. Now, it's true that this experience is not shared across Africa, and there are some countries where access to digital services for digital financial services is much more circumscribed. But I think it's important to not relate this to whether or not a country has a central bank digital currency. Now, even in this space, I think it's important to add that, increasingly countries are looking at ways in which either directly by, for example, the creation of the e-Naira in Nigeria, or indirectly by facilitating greater financial private sector market access. There's a lot of attention being paid to this.
Now, as African economies struggle to recover from the effect of the pandemic and the global recession, what role can innovations like the digital currency play?
So I think, innovation is going to be really, really important. And the thing about the whole digital revolution that really is important for our countries is the scope that it gives us to leapfrog and adopt newer ways of doing things differently. Take, for example, taxation. I think governments can and should be using more, access to information via digital resources, asking taxpayers to pay taxes, online more so than using the traditional frameworks. Also providing more transparency in terms of, how they're spending money through, by putting a lot of information out to the public.
So what are the key interventions that need to be implemented to help navigate the ongoing economic crisis?
Right now, we think that the priority should be in terms of addressing the sharp increase in food insecurity that has gone up as food prices have, surged really drastically. The urban poor and other vulnerable groups are really feeling a big pinch. So addressing food insecurity, we think, is a very important priority. As well, of course, central banks need to, calibrate policy to make sure that they keep inflation contained, because again, inflation has been surging in the region really aggressively for the first time in about 14, 15 years. And also, ministries of finance, ministers of finance have to focus a bit more on making sure that debt problems don't get out of hand, doing reforms to generate more tax revenues and the like.
Thanks for those insights. Now, the UN Food and Agriculture Organization estimates that 37% of food produced in Sub-Saharan Africa is lost between production and consumption. It means the continent loses or squanders a third of the food it produces, where 146 million people are going hungry. A group of African entrepreneurs believe handling food produce from harvest to delivery, including processing, is a way of reversing the trend.
Once a month, this farmer goes to his banana field located out of Ponwa on Congo's Atlantic coast to maintain his plantation and to harvest the ripening fruits. From this 6-hectare field, he's able to produce up to 3,000 bunches of bananas, but can only sell half of the harvest. To limit his losses, Christ Panino contracted a startup company that is working to transform the bananas into gluten-free, multi-purpose flour.
We're
revaluing the banana into a diverse product. In our range of products, you find multi-purpose banana flour, which can be used to make porridge, fufu, but also pastries, and banana couscous, which can be accompanied by all sorts of dishes. Here, nothing is lost. Even banana peelings are recovered to be used as cattle feed. One of the problems that we want to solve is to have an impact on imports. Since the Russia-Ukraine conflict, which will soon be a year old, we have noticed that the cost of wheat has risen on the market, as has the cost of any other product. And it is because we are so dependent on imports. We need local solutions. Beyond the need to raise revenue through agricultural exports, Ebere Akadiri, a food export expert, says farmers could be better supported through government policies to make the continent food secure.
We need to produce enough food to feed our people before we even think about exporting the food. So if we want to add more value, we really need to focus on supporting farmers locally with their with first finance capital, right? And then the know-how, which is technical know-how. How do we bring enough yield? Because if you don't, you might not be able to meet the standard set by the international markets. So how do we train them on those standards, have enough testing to make sure the food quality is up to standard? So there's really a lot to be done, but I think the focus should be on capital.
The Food and Agriculture Organization of the United Nations estimates that food worth $48 billion is lost between the post-harvest and marketing stages in Africa.
A new liquefied gas field near Senegal and Mauritania's coastlines is bringing hope to Europe as it struggles to secure alternative sources after Moscow reduced natural gas flow to EU countries. The field could produce up to 10 million tons of liquefied natural gas per year. Here's more to that story.
Europe's hustle to secure alternative sources as Moscow reduced natural gas flows to EU countries has made the mineral scarce. However, a new liquefied gas field near Senegal and Mauritania's coastlines estimated to encompass around 15 trillion cubic feet or 425 billion cubic meters of gas, brings hope. Mauritania has signed a gas exploration and production sharing agreement with British Petroleum and US-based Cosmos Energy in a field located in Mauritanian Atlantic waters. BP, British Petroleum, noted that the reserve won't fill the gap that has already been created by the conflict in Ukraine, but is timely enough to help Europe reduce its dependence on Russian natural gas to power factories, generate electricity, and heat homes. Mauritania will start producing liquefied natural gas for the first time from November or December 2023. The field, considered one of the largest, could produce up to 10 million tons of liquefied natural gas per year at a total cost of $4.6 billion, according to the Oil Ministry.
That's all we had for this week on Business Africa. As always, share your feedback with us on the social media platforms at Africa News. For more business news and stories, stay tuned to Africa News and africanews.com.